Hello and welcome. You're tuned into CNBC TV18 Prime. Let's get cracking on a brand new edition of The Big C. I'm Manisha Gupta, back with your daily dose of commodities, cryptos, and of course, currencies. On this show, we decode the global commodity storyline as it evolves against the backdrop of the tariff anxieties and macroeconomic unpredictabilities. Joining us on the show today are Soni Kumari, she's commodity strategist at ANZ, and Callum Macpherson is head of commodities at Investec. Well, before we go to our guests and deep dive into these conversations, let's take a quick look at the global markets. Stocks on Wall Street and Thursday's trading session lower ahead of the Fed Chair Jerome Powell's speech at the Jakson hole. The S&P declined for the fifth straight day in a row, while the Dow dropped 150 points today. Meanwhile, the stocks in the Asian markets are trading mixed, tracking the Wall Street's moves. South Korea's Kospi traded slightly higher, while Japan's benchmark Nikkei 225 slipped even as the country's core inflation rate cooled to 3.1% in the month of July. Meanwhile, back home, frontline stocks pulled indices lower amid prevailing global geopolitical uncertainty. Take a look at the gold prices in the meanwhile, and they have extended its recent declines to around $33.30 per ounce, holding within a tight range as traders avoid major moves ahead of the Fed Chair Powell's remarks. Gold slip allows for the US dollar to strengthen. The US dollar index was up 0.5%, making the dollar index priced gold expensive for the overseas buyers. And now shifting focus to the crude oil prices, the prices rose a percentage point overnight as hopes for a swift U.S. brokered deal to end the Russia-Ukraine war faded. Reports pointed to Russian airstrikes near the European Union border and the Ukrainian strikes on a Russian oil refinery. At the same time, the U.S. has stepped up pressure on India over its Russian crude purchases, announcing a 25% tariff on Indian goods effective 27th of August. With the oil making up nearly 35% of the Indian imports from Russia, this has been a case of concern for most of the world. In fact, the U.S. latest threat on India comes from White House's trade advisor Peter Navarro, who has once again accused India of perpetuating the Ukraine war and added that India's buying of Russian oil is nonsense. Let's listen in.
Prior to the invasion of Ukraine in February 2022, India bought virtually no Russian oil. I mean, it was like 1% of their needs. So the argument somehow now, as the percentage has gone up to like 30 and 35%, that somehow they need Russian oil to cool their homes or cook or drive their cars is nonsense. 25% because they cheat us on trade, 25% because of the Russian oil. I ask you this, what is the net impact on the Americans because of our trade with India? Well, let's think about it. They have higher tariffs, there are Maharaja tariffs, higher non-tariff barriers. We run a massive trade deficit with them, so that hurts American workers, hurts American businesses.
Well, that's being reiterated yet again that India has Maharaja tariffs and buys crude cheaper from Russia and sells products on a higher prices. But let's get deeper into that, and joining us for exactly that is Soni Kumari. She's commodity strategist at ANZ, and Callum Macpherson, head of commodities at Investec. Both joins us at this point in time on the show. Soni, I'll start with you first. And we've been hearing, listening, reading all those statements that various U.S. People in place of authority have been making, especially when it comes to crude one, and then, of course, on India as well. What has been your own analysis on this?
India's imports of oil from Russia has increased. Rightly mentioned, like earlier, it was like back in before 2022, it was like 1%, and now it has increased to 35 to 40%. But if you go back to 2022 situation, I think even the Western world, they wanted to Russian oil to flow to the other markets. So if it wasn't flowing to the other markets, I think oil prices would have gone through the roof to 150 or 200 per barrel. So that those times, I think India and China, they stepped up to absorb those Russian barrels and keep the oil prices not going to unsustainable level, where consumers would have been hurt and the economic growth would have been hurt more. So now, blaming India to stop, taking Russian oil, I think that move is not justified. And India has also made it very clear that, India will continue to buy Russian oil, and they have not given any directives for state oil companies not to buy. So coming to the fundamentals, how it's going to impact oil fundamentals here, the talks between Russia to end the war between Russia and Ukraine, it's going on. So we don't know what would be the outcome of these talks, but we can put two scenarios here. One, if they reach the deal, which is looking elusive, but in that case, only the market sentiment will change, not the fundamentals, because Russian oil flows are quite smooth, and Russia will not have much capacity to increase. So fundamentals are not going to change. There will be some kind of knee-jerk reaction, which we could see oil prices falling because of reaching, or the uncertainty will be resolved. But on the other scenario where, which is looking very likely, that US will enforce secondary sanction on India as well as on China. So this is going to have positive impact on prices, because India imports nearly 1.6 to 1.8 million barrels per day from Russia. And those volumes, cannot be absorbed by alternative markets because the scale of imports which Russia and China import, I think that's going to be, difficult for other markets to absorb. So any disruption on Russian oil flows is a bullish risk. And that's why we are seeing oil prices holding near 67 and 68 per barrel right now.
So you played out both the scenarios on what the street can really look at, but if you would also want to add the price view on that, how would you look at the prices if there is a disruption? And if there is actually a peace deal reached, then how do you see the prices?
See, if we are seeing a peace deal reach, between Russia and Ukraine, there'll be, prices, declining to lower 60s level. But we are not in that camp of, prices going to fall below 60 and sustaining there. Though the, fundamentals for quarter 4, like the quarter 3, it's still marginally in surplus. Market is marginally in surplus, but in quarter 4 it's going to be challenging. But we do see that opaque production supply policy, it's going to play a major role there. They have already unwound 2.2 voluntary production cut deal. And so that also gives them, leverage to pause for some time when demand is not very strong, and they know the market very well. So we expect OPEC to pause their, bringing additional barrels to the market when demand is not very strong. And on the other side, the other story is the slowing production growth in the US. We are expecting a very strong slowdown in oil production growth in the US, and maybe next year it could even slip negative. So that front, I think the fundamentals will be protected. We are expecting, prices to remain in the range of, mid 60s. Even in the next year, it will be in that range.
All right. Callum, hi, getting you into this conversation as well. While we've spoken about Russia and Ukraine and OPEC and US production as well, but it also is about the Chinese demand. It also has to do with tariffs and, of course, the interest rates and Jakson Hole meeting. There is just so much to watch out for. How are you looking at the crude oil prices in the light of all of this? What are you watching?
Well, I think if you look at, there is obviously quite a wide range of views at the moment about what the balance of the market is and how that's going to evolve, notwithstanding the tariffs and the Russia-Ukraine conflict and that sort of thing. But I think it seemed, if you look at the IEA's numbers, for example, they suggest that the market is in a surplus and that surplus is likely to widen throughout in the remainder of this year. As has been mentioned, OPEC Plus have been unwinding their additional voluntary cuts of those members that signed up to them, and indeed that they've now put through, or as of September, they will have put through the full unwind of those cuts, which had originally been intended to happen over an 18-month period, ending in September next year, but they've ended in September this year. So this led to a little bit of a mystery in the market. If you look at the shape of the forward curve, which is downward sloping, this tends to point to consumers being keen to buy oil rather than wait until buy forwards where the prices are lowest. They're buying now. So that tends to indicate that the market is actually quite tight, even though, of course, we're talking about a surplus. An explanation for this sort of conundrum seems to be that there is quite strong inventory buying, particularly in China. And of course, the Chinese, I imagine, are watching what's going on there. They are aware of obviously what Trump has said and the tariffs that have been imposed on India or are due to come into force next week. And of course, see the risk of the same thing happening to them. So, of course, it makes sense for them to buy up as much oil as they can do, especially as prices are not that high at the moment. But of course, that can't go on indefinitely. So if, in the scenario that the talks with Russia and Ukraine do start to evolve in a constructive way and the market becomes more sort of confident that that's going to work itself out somehow, then the supply, the oversupply starts to become an issue. The focus of the market turns back to demand being relative, demand growth not being very strong, and the negative economic consequences of the tariffs. And then I think we could see prices slipping quite a bit. I mean, let's not forget that the initial reaction to Trump's tariff announcements was a collapse in oil prices, and they.
Callum, Soni's kept her crude prices expectation at lower 60s to mid 60s. With the kind of view that you have, which does seem more bearish on the lower side, do you see then the crude oil price is breaking below 60?
Well, I think that's certainly possible. I mean, whether they stay below, of course, is another matter. And one of the questions, of course, is well, let's say there is an oversupply in the market. The real question is, what does the price need to fall to disincentivize production so that the market comes back into a balance? What does that price need to be? And of course, that's when you start to think about some of the higher cost production in the world, such as US shale, and it probably may not need to fall very far before we do start to see a supply reaction in the US and possibly other high-cost sources of production.
Point taken. Well, yes, there's just so much to watch out for when it comes to the crude oil price. It seems to be becoming an international conversation at this point in time with just so many fundamentals to watch out for. But do stay on with us. We will slip into a very short break. When we come back, we will ask questions to our experts about the Jakson Hole meeting, its impact, of course, on the US dollar index and the metals therein after this break. Welcome back. We still have with us Soni Kumari, Commodities Strategist at ANZ, and Callum Macpherson, Head of Commodities at Investec. Thank you so much for staying by. Callum, how are you getting into Jakson Hole meeting? I mean, it's at 2 p.m. GMT as per the timings. And until then, we haven't seen volumes grow or open interest for sure in many of those trades in many asset classes. How are you watching it? How are you preempting the kind of statements that we can see from that? And how would you read into this 0.5% of a gain in dollar index ahead of this?
Well, I think for most commodities, really the driver will be actually how other markets behave. So it's really more about sentiment, and how will equities behave? Do they go up or down in response to whatever the comments are that come out of the summit? And then we'll see that feeding through into oil prices. Obviously, gold is a bit different because that sort of has a more currency-like behavior, and is a lot more sensitive directly to interest rates. Whereas for other commodities such as oil and industrial metals, it's really much more of a secondary factor for those markets, I would say.
Callum, immediately after this, of course, there's a couple of more data between now and 16, 17 September. That is when the US Fed meeting, as well as what would you watch out for? And if there was a long-term strategy to make for gold, what would that be?
I must say, I personally, I find gold a very tricky one to understand because it's very different to other commodities. It doesn't really have a storage cost, which is very low compared to its value. It's the amount of inventories are massive compared to actual industrial demand. So its characteristics are just completely different to other commodities. You can't really look at supply and demand and try and work out what the price ought to do. It's very much sentiment driven, and of course, got at the moment for particularly this year, sentiment on gold has been very driven by sort of risk aversion, fears of things that are going on in the world, and of course the prospect of high inflation and higher borrowing and this kind of thing. So easing monetary policy essentially.
Soni, what's your sense? How are you looking at the gold and the dollar index behave in the near term to slightly longer term?
I think, Manisha, right now the market is in wait and watch mode because investors are, keenly looking at today's Powell's speech. So what he has to say, about the economic outlook as well as the monetary policy framework. So after, the latest for non-farm payroll data and, very benign inflation print, market is already pricing 25 basis point cut, right? So investor will be looking out for whether what is his tone, whether it's hawkish or dovish, because he has been saying there are a lot of uncertainties around inflation because of tariffs. So investor will be keenly watching his comments around that point. And what we see on the policy rate side, that the core inflation is gradually in downward trend, and we expect the Fed to go ahead with 25 basis point cut this year. We also have viewed that there will be another rate cut, in December, and in the whole, this monetary policy cycle, there will be another, there will be total 3 policy rate cut of 75 basis point, and this will end by end of March meeting. So that's our view. So a direction to in lower policy rate, that's going to be supportive for gold prices. And apart from that, there are other factors which will be supportive for gold prices as well. If you look at the geopolitics, I think it's despite the ongoing talks around ending the war between Russia and Ukraine, I think it's going to be a long drag because there are many parties involved and there are many teething issues. Those need to be settled down, and so in the background, the geopolitical tension will continue to run, and that will be providing safe haven appeal to gold. On the further on the the trade tariff side, there are a lot of uncertainties, though things are not looking as bad as we saw back in April, but definitely uncertainties are there, and effective tariff rates by the US has increased to 20%, and that's going to have some macroeconomic implication on both the GDP as well as on inflation side. So that will keep investors looking out for having assets, and that's going to support gold prices. It means that makes a very strong investment case for gold.
Oh, sure does. Callum, with the kind of market that we are in right now, where there's just so much uncertainty everywhere, so whether it is going to be about currencies or commodities for that matter, where do you see a better safe haven emerging in this kind of a space? What would you advise clients?
Well, I'm afraid I can't give advice because I'm not a researcher. But I suppose diversification. That what else can we say? No, look, it's extremely difficult, isn't it? And I think it's but in reality, markets are always have lots of uncertainties, and so I don't know how much more uncertain the present situation is than at other times. So, but I think for I think for commodity markets at the moment, I think that we'll probably start over the coming weeks. We'll start to see more concerns about the talks between Russia and the US and Ukraine having difficulties. I think we're already seeing signs of that, and the market's already starting to react to that. So I would see that as being a particular area of uncertainty for commodities at the moment.
Callum, let's talk about industrial metals then. And of course, copper has been one example on what volatility can be defined as, from that all-time highs to 25 to 28% of a decline on that one. And the other industrial metals also seem to be in a wait-and-watch mode. I know it's a very difficult time to start looking at prices and on where they really could be getting. But Callum, what's your sense on industrial commodities, industrial metals, base metals, that is?
Yes, well, obviously these have also been heavily influenced by tariffs over the course of this year. I mean, in the case of steel and aluminium, sort of actual tariffs, and more recently copper as well. But even before the tariffs were actually introduced, clearly markets could see they were around the corner. And if you imagine you're a manufacturer in the US making something out of aluminium that you're importing from abroad, then your reaction to tariffs, talk of tariffs being introduced, is going to be to go and buy as much of that stuff as you can, build up your inventories. And so that we've had phases of stock building, and then tariffs coming in, and then so domestic stocks building up, and then international stocks falling as a consequence of that. So this has really complicated price behavior over the last 6 months, really, and made it very difficult to actually disentangle that from the fundamentals. I suppose it's true of the wider economy as well, actually. But copper, although it has been quite volatile, as you say, it's actually been relatively range bound in recent months, in this sort of $9,500 up to $10,000 per ton kind of range. So I think the interesting thing is to see if we do get a break out of that at some point.
Soni, what is your own sense in the metal space? Do you also believe that copper prices now, as stuck, as Callum mentioned, could be looking at highs? I was recently talking to BHP, and they are anticipating greater highs. Bank of America anticipates 10,000, even 12,000 in coming few years. Are we looking at very strong gains in copper coming in?
Manisha, I would like to differ here a bit. See, medium to long term, copper fundamentals are quite supportive because it's used in energy transition, which is creating a structural demand for copper. While on the supply side, investments are just not enough to increase the supply to meet the demand which is coming from energy transition. So that remains the medium to long term backdrop. But what we have seen this year and the first half of this year, copper prices were influenced by two factors, as the tariff-related things, which led to a front loading in the US. And if you look at the imports in first half by the US, it has risen to more than 140%, and in terms of volume, 850,000 tons, which is quite a lot. So in the second half, what we expect that second half, this is the front load is going to wane. This is going to unwind. So there not be enough demand from the US coming in to support copper prices. On the other hand, if I have to look at macroeconomic story, first half was quite strong, and that's also because of the front loading. all the key markets, if you take US or China, the first half economic growth was quite strong. Even industrial activity was quite strong. But in the second half, we expect the same thing to unwind. And for China, the first half growth was 5.2%, and the second half we expect, the growth to be a bit slower. So that's going to weigh on demand for all the industrial metals. So what we think that in the second half of this year, copper prices are going to be on weaker side, and we expect copper prices to retrace towards 9,500 by end of this year.
All right, so not so much support coming in from metals at this point in time, and that's because of so much uncertainty that we are looking at in the international market space. Thank you so much, Soni, Callum, for coming to us on a day where the uncertainties are perhaps at the highest, because we do not know what's going to happen at the Jakson Hole meeting, the kind of statements perhaps Jerome Powell will put out in sense of future policies, interest rate cues if he gives that, and whether or not he talks about the US Fed independence. So, well, absolutely, all asset classes will be taking cues from that. And then, of course, it's a weekend, so much of the reaction would perhaps come in on Monday. But thank you, both of you, for coming across and making sense of what really is happening in the international market there. And with that, that's all the time that we have on Big C today. More news and updates on the other side.